Good afternoon, everyone. Thank you for taking the time to join us today for the Asia in Focus 2Q26 Global Credit Outlook implications. My name is Pramod Shenoi. I'm the head of APAC Research and APAC Financials Research at CreditSights. So today from CreditSights, we have Zerlina Zeng, head of APAC Strategy, Lakshmanan, head of South and Southeast Asian Corporates, as well as GCC Corporates. Nicholas Chen, who's analyst with the East Asia Corporates team. And we also have a special guest with us today. So Dheeraj Bajaj is CIO at Lombard Odier Asset Management for the APAC region. Dheeraj is responsible for both fixed income and equity investments. Today we'll have him for his opinions with his fixed income hat on. So thank you very much for taking the time to join us, Dheeraj. For all our attendees, we do have a Q&A panel at the bottom right-hand side of the screen. Please do put in your questions. We have a reasonable agenda to run through today, so we may or may not be able to respond to your questions during the course of the webinar, but we'll certainly get back to you after that. So at CreditSights, we had our US and European outlook published on Thursday, the 2nd of April. This webinar is to walk through what the implications of those are for Asia, and also to provide our more recent thoughts on credit events around us. We're really happy to have Dheeraj as well for his thoughts on what he's seeing in the world, as well as his comments on our recommendations. So with Zerlina, if you could walk us through what's the CS outlook is for US and the implications for Asia. Thank you.
Yeah, thanks, Pramod. I think it's a very difficult time to do outlooks for all the strategists, and we try our best to do forecast while also trying very hard to maintain our mental health. So in the US, we now expect the Fed to cut rates by 25 basis points in 2026, down from 75 basis points previously. We expect further labor market weakness, with the unemployment rate rising to 4.7% amid AI disruption to white-collar jobs. We think the Fed is unable to respond quickly, though, to the labor market weakness, because the headline inflation will remain elevated in the near term due to the energy supply shock and delayed tariff pass-through. That said, we think the threshold for a hike is still much higher than a cut, as higher energy prices result in demand destruction and are ultimately disinflationary. We forecast the Fed to cut towards the year end and lower terminal rate to 2.5% by 2026, which is still dovish than the current SOFR future pricing of 3.4%. We still do not rule out the Fed delivering a heavier or 75 basis point of cut of backloaded cut if recession risk looms large towards year end. Now, with our revised Fed call, we expect the 10-year US Treasury yields to decline to 3.75% by year end as a base case. This is up from 3.5% previously. We also have a probability weighted 10-year forecast at 4.2%, which is 35 basis points lower than consensus. So the construction of this probability weighted forecast includes a bear case of stagflation-like scenario at a probability of 30%, up from 15% previously, as well as a bull case of Goldilocks disinflation at a reduced probability of 15%, down from 30% previously. The 10-year yield forecasts under these two scenarios are higher than the base case scenario. We have an overweight recommendations across the US Treasury yield curve. So at the short end, we think the repricing of monetary policies across developed markets, including the Fed, ECB, and BOE, have been too aggressive, and we would like to fade the movement. And at the long end, we think fiscal concerns are indeed real, but with growth and labor market headwinds, we think US inflation break-even now rising above 2% is an overdone. We view US 10-year yields at 4.5% and break even at 2% as a high conviction buy for US Treasury. Now, when it comes to duration strategy, we are strategically long and tactically cautious and honestly a little bit confused, just like all the market participants. US Treasuries are trading like a risk asset with high correlation to equities during this wartime. This also means there could be some short-term pains to long-dated credits if US Treasury overshoots on headlines. But we think current oil yield levels are attractive for long-term real money investors, talking about 5% in US IG and 7.5% in US high yield. That's why we have overweight recommendations for total return mandates in both US and Asia dollar IG credits. In Asia credits, our preferred duration plays are China Tech and SOEs, Indo quasi-selected corporate perps for convexity plays, and Japanese lifer subdebt. Now, moving on to credit risk, I would say we are still quite cautious and we expect the spread to widen across global fixed income markets by year end. Honestly, spread correction since the war is very shallow, only a few basis points in IG and insignificant in high yield compared to historical large market sell offs. In US IG, we are still wary of the supply risks. The US strategy team revised up the 2026 US IG growth supply to 1.5 to 1.6 trillion from previously 1.4 to 1.5 trillion, partially driven by the large tech, especially hyperscaler capex, forecasted at 750 billion and supply at close to 100 billion per our US technology team. In the US high yield, we still think the AI disruption and private credit related liquidity issues will pose additional downside risks to spreads. And because of these, we still have on the wait for excess return mandates in US IG and US high yield. But we tightened spread forecasts in both US IG and high yield. So for US IG, the year-end forecast has been tightened to 110 basis points from 120 basis points, and in US high yield, it has been tightened to 400 basis points from 450 basis points. And this is because in IG, US IG, we think the higher oil yields will continue attracting flow to the higher credit quality credits. Actually, US IG inflows has slightly outpaced money market funds year to date for the first time since 2017. And in high yield, we think high beta energy high yield names will aid the US high yield segment. We still prefer US high yield over BSL because we prefer fixed over floating rate because of our constructive rates view. And we see continued fundamental concerns in the BSL market, particularly the software related segments. Now we move to Asia credits. We revised our Asia dollar IG and high yield to market weight from underweight for excess return mandates after the war. I would say I was struggling a bit when we made this adjustment, but so far it seems the call has worked out. Asia dollar IG outperformed the Euro, US, EM dollar sovereign peers, and Asia dollar high yield marginally ahead of Euro and EM dollar sovereign in terms of a spread performance. We still see a good chance for Asia dollar IG to continue trading inside US IG thanks to negative net supply, solid starting point of credit fundamentals, and very good local funding conditions, particularly in the bank loan market, thanks to a lot of regulatory backstop for injecting the liquidity. Even though I think in March, the Asian rates also sold off alongside the developed market rates. In Asia dollar IG, we remain overweight Greater China credits, including high-grade tech, SOE hybrids, and property. And for excess return mandates, we focus at short end, and for total return ones, we like to 7 to 10 year part. We see good opportunity in new issues as issuers are paying up 15 to 25 basis point of premiums in the recent March new issues. And in Asia high yield, we focus on alpha opportunities in China high yield industrial, Indonesia, and Indian spaces. And lastly, I want to quickly talk about the Asian local currency bonds. We are still strategically positioning in this space, particularly AUD corporate bonds. This market has been resilient in the war with spread widening less than the US IG, Asia dollar IG, and European peers. AUD rates also sold off along the DM rates, but the magnitude was less than European government bonds. We think the RBA is now leaning hawkish and see one more additional front-loaded hike to manage imported fuel inflation pressure, but we think the room for further higher AUD rates is limited given aggressive market repricing year to date and actually since the second half last year. We are also not bearish on Australian dollar as higher commodity prices would aid the country's terms of trade. We see attractive value and entry points in AUD papers now, such as European and global bank papers, as well as large domestic rates and utility hybrids. That's a quick one from me. Back to you, Pramod.
Thanks for running through that, Zerlina, in terms of both the US views as well as where we think it makes sense to play in Asia and indeed the AUD currency space. I'm now going to turn across to Dheeraj. Dheeraj, how do you view Asian winners and losers from the conflict? What's it that you're seeing?
Thanks, Pramod, for having me here. I think even before the conflict, we had a view that we are in a very different macro environment than what we have been in the past decade. In the past decade, after the 2008 GFC, we have been in a low growth austerity era in the West. And now we've actually post-COVID and with significantly more geopolitical tensions during the Biden era and now in the Trump era, we've moved to a greater government spending environment. And so we do prefer assets in credit that have more growth proxies and are more linked towards production of industrial goods and services. So, three key reasons why we believe that we're in higher spending environment. One obviously is the Cold War between technology in between US and China. So I think that promotes a higher spending environment between the two countries. Second is higher government spending in both defense and sovereign AI. And thirdly is the ongoing AI technology revolution. And so to support all of these things, we have preferred commodities as our top sector coming into 2026, metals and mining. So there we have our long-standing holdings in Southeast Asia, India, such as Vedanta, Freeport, and so on and so forth. And with a cautiously optimistic environment on oil and gas, whether it's Australian long-dated IG assets there, Indonesia, Africa, oil and gas assets upstream and so on and so forth. And obviously with the Middle East conflict that basically just goes on steroids, the entire oil and gas complex. So those two remain our kind of topics in this environment. So we've got more tailwinds there. Then secondly, energy assets and infrastructure. So anything from pipelines, renewables, ports, electricity generation, transmission, across Southeast Asia and India. I think those are very, very strong assets that cannot be rebuilt in short order. And, those are still going to be very strong assets that will continue to pay. Then thirdly, I think refining that was not in our agenda, which we were negative on refining and petrochem industry generally prior to this. I think it's a little bit of a mixed bag, but there are enough names within Asia, especially in the Thai complex, that we think will benefit from feedstock continuity because of vertical integration, and also will benefit from higher crack spreads going forward. So that's a new sector that we like. And then beyond that is the more resilient sectors of investment grade banks across APAC, including Japan, Australia, and also the high yield sector of NBFCs in India. And then last and not least, I think China and Hong Kong, whether it's property, high yield, industrial assets there. China is really very insulated from a macro perspective. And I think that's where we can be very constructive on not just the technicals, but also the underlying businesses that we can see, which are very decorrelated away from EM, Middle East, and any global shocks. So I think that's in a nutshell of what we like. But we also are not shunning entirely the Middle East. I think, we do think that this conflict is going to be de-escalated at some point in time. Obviously, we don't have the capacity to predict it. But amongst the Middle East countries that we feel the most comfortable is Saudi, especially in the investment grade segment in the banks, given the strong capital ratios and a lot of capital that has been raised by the Saudi banks. And it's a very domestic focused economy with good sovereign buffers, unlike the UAE, which is very dependent on transient population and expat and international capital. So let me just pause there and hand it over to you.
Fantastic. No, thanks for running through that and and your views. I think that there's a fair amount of similarities in different opportunity to run through the financial side of things and how we are viewing the financial sector in APAC with a few comments on the GCC as well. So in the financial sector, obviously EM affected more. So we have been historically entering into this year more cautious around Indonesia, Philippines, and Thailand, both from a combination of valuations as well as just plain macro and what we are seeing. So we are largely underperform in these countries, and of course the current situation has added to that. In India, we are perhaps a little, we see fair value in terms of the spreads, but cautious. We also think that the non-bank financial institution sector has been oversold. Yes, asset quality is going to credit costs undeniably are going to go up, but I think in terms of the yields that you're getting now, that's quite attractive. So we cover all the names with the exception of Samman Capital. We have outperformed recommendations on pretty much the entire space, and that's a sector that we think does provide good risk reward at this moment. We also agree that the developed markets are better spaces, so the Australian and Japanese banks are very comfortable. Australian spreads have always been super tight, but it's a good space to hide. Japanese, on the other hand, I think you're getting a very good return from a risk-reward perspective. So we have an outperformed recommendation on the Japanese banks and most of the insurance companies as well. We also agree with China being a haven trade right now. And although we do see the spreads as particularly tight, we recently moved the entire segment of joint stock banks from an underperform recommendation to a market perform recommendation. We moved post the AMC results to market perform, and the ex Huarong and Citic Asset Management from market perform to an outperform recommendation. I wouldn't have thought that we would have seen this particular issuer move to an outperform recommendation, but that's where we are in today's day and world. It's a substantially de-risked credit. We're slightly more cautious around Korea, and that's not necessarily a war implication point, but it is more an implication of the Korean won and the amount of FX and derivatives that the Korean banks have on their books. So what tends to happen is that non-interest income in Korea gets hit quite strongly, and OCI gets hit quite strongly by FX volatility. So we do anticipate that results will be affected perhaps more in the first quarter than what we saw at year end. And of course, the valuations in the Korean banks aren't great. So for choice, Korea is something that we'd stay away from. Just briefly looking at the GCC, we put out a note yesterday saying that, look, we are going to have a look-through view on where spreads are. Spreads have widened a fair amount in the Middle East, understandably, but not that wide compared to the fact that there's a conflict that's on right now. So we covered 10 banks. We've got QNB from Qatar. We've got the top 5 Saudi banks. We've got the top 4 UAE banks. And how we look at the Middle East is that we anticipate, Qatar is obviously most affected because it can't get its supply out. Saudi is actually doing fine because, they're actually making as much money, if not more, thanks to the fact that oil prices have increased a lot. And again, banks seem to be in reasonable shape. There isn't any Houthi effect. UAE is more a question of this of the slowdown in growth going forward. So that again is something that we're trying to see what the credit trajectory looks like. We have no problems in terms of liquidity. We anticipate, obviously, credit costs will increase in the UAE, first for personal unsecured loans, but at a later stage, some amount of regulatory forbearance is already being granted, but you will see some credit costs coming through in the coming quarters for the SME and the corporates which are in the real estate and logistics space. So that's what we anticipate. So at the moment, we've got a market perform recommendation pretty much across the sector. If you were to have asked me before the conflict, what are my preferred trades, I would have said Indian NBFIs for the 2 to 3 year space, high yield names, Saudi banks for 10 non-qualified tier 2, and Japanese insurers for the non-call 10 category, because its risk reward is fantastic. Good to see that 2 out of the 3 still stand as the conflict continues. And for the banks, again, very much a function of how much this escalates. So for the moment, we would recommend caution with investments in the Middle East. But as and when the conflict winds down, there definitely could be opportunities there. So I'm going to move on from the financials world and invite my colleague Lakshmanan to walk through what he's seeing from a South and Southeast Asian corporate's perspective, and again, brief comments on the GCC credits under his purview. So, Laksh, across to you. Thank you.
Thanks, Pramod. That's a good segue to look at how we are seeing the impacts on the issuers in South and Southeast Asia on the back of the ongoing Middle Eastern conflict. So we have got a couple of questions from clients, and we tried to address it by looking at what does it really mean when we are expecting a continued shortage in natural gas and higher natural gas prices, and in general higher crude oil prices for many of the issuers. We have seen that many of these Middle Eastern energy companies' facilities have been targeted, the infrastructure has been damaged, and the supply chains remains quite constrained, given the Strait of Hormuz continues to be cut off. The Qatar Energy's major facilities was attacked a couple of weeks ago, and that is expected to continue to remain out of service for a very long period, maybe up to even 3 to 5 years. That would mean that the natural gas prices would be in short supply, given Qatar is a major producer and supplier of natural gas. From the South and Southeast Asian issuers, we see that the fertilizer company could be something that could be negatively impacted, as they have a reliance on natural gas as a key feedstock. And that would, for names like a UPL, they would either face shortage or much higher cost for these feedstock supplies. That could also feed into higher food inflation for some of the geographies which are quite reliant on fertilizers, such as India is one of the more prominent markets out there, which is where the rural community, the farmer community, is quite reliant on the fertilizers, and therefore the spiraling of cost could have other ramifications. Some of the other sectors like the power is also come into focus, but we see a few mitigants. So for names like SMCGP, Chikran Lishtindo, or for that matter, the Saudi electricity. In many of these South and Southeast Asian power producers, they're quite coal reliant. They also have a cost pass-through mechanism in place to pass through the cost to their customers. And in certain instances like Chikran Lishtindo, they also have domestic natural gas supplies. So therefore, the impact is a little bit mitigated there. With respect to the mid or downstream oil refiners, particularly like Reliance Industries, we take comfort despite the higher crude oil and cost, in that they have flexibility in their feedstock supplies or the nature of it. For example, Reliance is dependent on, also has the flexibility to switch to ethane feedstock. They also have very diversified business presence into telecom, retail, which buffers some of the impact of the higher oil and natural gas prices. The metals and mining companies are something that could see higher cost inflation, as they have very high energy intensity. They use diesel for in mining operations, but we see some offsetting factors in that certain metals where these issuers are present, for example, aluminium or oil and gas, will or have seen higher prices, and therefore their top line should benefit. Indica is also could benefit from the switch to alternate fuels, in this case being thermal coal. So therefore their revenues could also increase, as thermal coal prices have also risen in tandem with oil and gas prices. Some of the other sectors will see some small impact, such as transport infrastructure, because they're dependent on shipping volumes, but airport because of all this air traffic restriction. But these are very small and small order, second order impacts, and therefore we are not excessively worried in terms of the shortage of oil and gas, or even the higher prices of natural gas on these issuers within these sectors. So overall, in general, for South and Southeast Asia, the impacts in terms of direct, fundamental, and even second order impacts are largely manageable. Something to point or to watch out for is the agrochemical, the fertilizer sector, but others have various mitigants in place. That said, I will just spend a couple of brief minutes to look at what are the recommendation changes that we have made, and also what we are seeing in GCC of late. So I mentioned to you about the production damage and the supply disruptions that Qatar has seen, and that is the reason why within the first few days of the war outbreak itself, we quickly moved Qatar Energy to underperform. And that has worked. And just a couple of days ago, Qatar Energies has seen its rating outlook being changed to revised down to negative by Fitch. We hold a similar view. Our views was based on a couple of factors. The Strait of Hormuz has been cut. Qatar Energy is overly dependent on that channel to ship its natural gas to various destinations in Asia and Europe. Secondly, the extensive damage to its Ras Laffan facility, which is a major production and export terminal. 17% of its capacity has been impaired for a long-term timeline of up to 3 to 5 years that could entail an expenditure or repair cost of up to $26 billion. So with that in mind, and we continue to maintain Qatar Energy's bonds on an underperform recommendation. On Saudi Aramco, we do agree with our other colleagues' view that Saudi Arabia is much more safer as compared to the likes of Qatar or UAE, Bahrain, Kuwait, etc. But we moved or downgraded Aramco to market perform about early in the days of the outbreak. But just a couple of days ago, we do not see any near, or rather, we do not see any tangible moves to de-escalate the situation between the warring parties. And with the Houthi risk still looming over the horizon, with the potential that there could be the risk of any disruption to even to the alternate shipping channel, which is through the Red Sea, we thought it prudent to be more cautious, and therefore we just downgraded Aramco also a couple of days ago from market perform previously to underperform now. And as we speak, a couple of hours ago, it's one of its major refinery at Al Jubail has also been struck by Iran, and there has erupted into very huge fire. So there has been infrastructure damage to Saudi Aramco as we speak. So that's the other change. In South and Southeast Asia, we upgraded Medco from market perform to, or rather, market perform with a preference on one or two bonds to an outright outperform on the entire complex. This is because it's a pure play upstream oil and gas producer with a limited presence in Middle East in terms of presence in terms of assets and business operations, except for a small plant in Oman. But we expect that it should benefit from the higher oil and gas prices, even as about 50% of its contracts is fixed in nature. The rest 50% is indexed to the oil and gas prices, and therefore it should benefit from the ongoing high oil and price environment. I wouldn't go into too much detail into the other recommendation changes, but we have kind of toned down our earlier preferences on Vedanta, on SMCGP, given a slightly more risk of environment and given these are high beta names. And we kind of are positioned so forth, and we remain a bit more cautious in general on the Middle Eastern credits until we see tangible progress on de-escalation in the Middle Eastern conflict. I'll stop here in the interest of time and hand it back to you, Pramod. Thanks.
Thanks a lot, Laksh. We'll move next to Nicholas Chen. So Nick is going to walk us through the segment of the market which is quite different. Hong Kong property, Macau gaming, a little bit of GLP. So Nick, across to you.
Yep, thanks, Pramod. I will start off with the Hong Kong property market first, which just from a high-level perspective had a rather shaky start to 2025, though things started to improve in the second half of last year and then into early 2026 as well. So on the office market, it had remained challenging last year and was still characterized by elevated overall vacancy rates and downward pressure on average rents as overall office supply continued to creep upwards from recent completions such as the IGC. But on a more positive note, capital markets activity in Hong Kong remained strong in 2025, while vacancy rates across Hong Kong had also largely trended lower for the first 2 months of 2026. However, we think it is still too early to ascertain that a broader market recovery is effectively underway, especially with the additional supply remaining a key headwind. On the retail scene, the retail market also had a sluggish start to 2025, but saw some recovery in the second half, which was mainly driven by the luxury categories. And encouragingly, the positive momentum also continued into the first 2 months of 2026. Tourist inflows also remained robust, which we think was likely aided by the weaker Hong Kong dollar in the second half. But spending by the mainland Chinese visitors, this is the largest group of tourists into Hong Kong, there was only up marginally by about 2% in 2025 and still notably lower than past years. Lastly, on residential, so residential had done well with the total primary and secondary home sales volume rebounding over the summer last year and then performing well into the first quarter of 2026 and was mainly driven by strong primary flows. So residential rental prices have also been trending higher thanks to the continued inflow of students and talents. And there is still a positive rental carry over prime-based mortgages as well. So overall, there are some green shoots in the Hong Kong property space, and sentiment has been better compared to early 2025. But these are still early days, and I think we'll still need to see whether the encouraging data prints can sustain for the rest of 2026. From the latest earnings result, it's not surprising that we saw the landlords still posting negative office rental reversions in 2025 as they continue to prioritize occupancy rates over rental rates. And most are also expecting the negative reversion to persist into 2026, though potentially narrow year on year if office demand picks up. On the other hand, positive retail rental reversion and resilient retail occupancy rates were small bright spots for most of them. And for 2026, most are also still expecting a stable to improving trend in the retail space. And meanwhile, for developers such as Sun Hung Kai, they were more upbeat on the residential market and expect the positive momentum since the second half of last year to continue throughout 2026. I'll touch a little bit on the Middle East conflict, even though we see limited impact given that most of these Hong Kong names, their focus is more domestic, either in Hong Kong or mainland China. So there's very little to no direct operational exposure to the Middle East. And some of the landlords, such as Hong Kong Land and Swire, they also said that they saw potential opportunities for capital and tenant flows back into Hong Kong, given its stability and financial status as a financial hub. So within our covered Hong Kong property credits, we do have outperform recommendations on two names, namely Sun Hung Kai and Wharf. We think that they still offer decent spread pickups against the A1 and A2 rated Asia credits, and their credit profiles are also underpinned by very strong balance sheets, positive free cash flow generation, and robust liquidity. I'll quickly go through on the Macau gaming side of things. So it's quite similar to Hong Kong property as well. The Macau gaming sector had some turbulence in the first half of 2025, to the point where the Macau government also had to revise the full year GGR target in June of last year. But then total GGR for the full year of 2025 eventually surprised to the upside and surpassed both the revised and the original GGR target figures. And the positive momentum has also carried on into the first quarter of this year, with the monthly GGR also beating market expectations for January, February, and March. And in terms of tourist inflows, Macau continued to receive robust visitations, even posting its highest ever monthly visitor figure in August of last year, and then the second highest just last month. This was also seen in the recent Chinese New Year holiday, where the visitor count was higher year on year every day. However, the main weight area will be the spending by punters that we still see as constrained. And we think growing this figure would likely be a challenge for 2026 because we think that any further visitation upside would likely still come from the less affluent regions in China, which have lower spending power. Meanwhile, in terms of the Middle East conflict, we think that direct impact on the Macau gaming operators is also limited, given that the visitor and player bases are predominantly from the Greater China region. So for the Macau gaming operators, they posted largely decent 4Q25 results with higher top line and EBITDA as well as better debt metrics, apart from Wynn Macau that posted a lower EBITDA and marginally weaker leverage metrics. So within the high yield space, MGM China still remains our top pick, and it is the only high yield casino operator so far that has improved its leverage metrics beyond the pre-COVID 2019 levels. Meanwhile, we have an underperform recommendation on Melco, as we don't think that its current bond yields still adequately reflect its elevated leverage and the likely slowdown in its deleveraging pace for 2026. Yeah, that's all. That's for the Hong Kong and Macau side. I would now touch a bit on the GLP. This name has been in the spotlight recently, and we have also received quite a number of questions by our clients. So we have just thought we can talk a little bit about it here. That the dollar bonds have been on a downward cycle in the past few weeks amid quite a number of macro negative events. The most prominent of which is the reported window guidance by the Chinese regulators to the domestic insurance companies. This was what we saw as the biggest driving force for GLP's dollar bond prices. And in summary, the news purported that Chinese regulators have asked domestic insurance companies to limit their transactions with GLP China, though there wasn't any clarity whether this applies on a going forward or retrospective basis, and whether the insurers will need to unwind their exposure to GLP once the affected funds mature or with immediate effect. So the company has categorically denied the news report and stated that it has not received such a regulatory notification. But we did some channel checks and we found we did have some parallels between that reported window guidance and our own channel checks, mainly that the domestic insurers have grown a bit more cautious on incremental investments into GLP. So if this reported window guidance is true, there will definitely be some impact to GLP since the domestic insurers are anchor investors in some of GLP's funds. And the impacts will be in the form of reduced management fees from the potential unwinding of exposure by these domestic insurers, and then reduced participation from the insurers as well, reduced availability to sell on-balance sheet assets into newly established China funds, and lastly, also limited exit alternatives for the maturing affected funds. Now, we tried to ascertain the true AUM of the funds that will potentially be affected by the reported window guidance, but this will be a bit challenging because of the limited fund disclosures by GLP in terms of who the investor bases are, when they are maturing, etc. But nevertheless, we think that the impacts would likely be mostly medium term, as based on our estimates on the available disclosures by the company. Most of the funds with domestic insurers that disclosed as the investors are maturing from about 2029 onwards. And we also see the fact that GLP has very little near-term maturities, its track record of an optionality of capital recycling, as well as a decent net asset headroom as some of its comfort factors. And overall, we still have a outperform recommendation on GLP, but more from a medium-term viewpoint. And since the mid-March, when this window guidance news first surfaced, GLP's dollar senior bullets have also recovered by about 8 to 10 points. But that said, at this juncture, we think that position sizing is important, given the lower likelihood of the near-term catalyst materializing, which would likely also keep investors on the defensive. Yeah, that's from the East Asia side from my end. Pramod, I'll hand it over back to you.
Thanks for walking us through that, Nick. And for the participants on the call, we do have the full note which Nick and his senior colleague Payashu put together on GLP. That should be a link that is on the website, on this webinar website. So you'll have GLP window guidance and thoughts on recent events. That's one note. Our Lakshmanan also put together a note on Vistaland and his recent meeting takeaways with the CFO. And in addition to that, we have two other notes. One is on our US and European US IG outlook, rather, which is Taco Trap. And last but not the least, Asia Credit Best Ideas pieces. So these pieces, please do take a look at them. I think that you'll find some very relevant thoughts and ideas and fleshing out of some of the discussion points that we've had on the webinar so far. Just want to wrap up the CreditSights side of things with turning again to Zerlina for a quick run through of what she's seeing on Korean credits, because that's another segment. The Korean corporate credits have again been in the news quite a lot. So Zerlina, across to you.
Yeah, thanks, Pramod. So even before the war, we did already have some fundamental concerns for a few Korean credits for mainly two reasons. The first one is on the oversupply side. That's mainly relevant for the Korean steel sector, such as POSCO, because of the Asian steel makers were flushing the market with their steel production already before the war, and we have an underperformed recommendation on POSCO. The other industries, including the petrochemical, very excessive oversupply in the Asian market pre-war. And I think there's a question from the audience about LG Chemical. LG Chem already had a downgrade before the war, and their petrochemical section has already been in red for quite a few quarters. And the situation hasn't really been improved post-war because of the shortage of naphtha. The company is mitigating this by having some shipments from Russia, but it's still a very small amount. The other sector is front and center in most of investors' mind is the EV battery segment. So we are seeing a lot of pressure along the EV battery supply chain because of the changing industrial policy in the US, in Europe, competition from China, especially in Europe. So that resulted in the utilization being very low in EV battery names like LG Energy Solution and other parts makers, including the POSCO Future, which is subsidiary under POSCO, and relevant EV battery related material manufacturer. This situation hasn't really been improved, even though LG Energy Solution has been telling us they're expanding to ESS battery, providing battery storage for the AI booming sector and the increasing need for electricity demand in the US. But overall, we see this as a mitigating factor, but hasn't really changed the fundamental issue. The second headwinds facing the Korean corporates before the start of the war was the US tariff. So that's relevant for the Korean automakers as well as the electronic makers, LG Electronic. I think for the auto sector, our US auto analyst Todd is relatively more constructive on Korean automakers because of their EV battery model and profitability were ahead of peers, but still this is an industry headwind. For the LG Electronics, tariff is also hitting the company. It is doing a lot of cost mitigation matters, but still there is some hit to the EBITDA margin as well as the debt matrix. I think the only sector that was doing pretty well before the war and still doing pretty well now is the semiconductor. So that is SK Hynix. But I think honestly, our US sector analysts in technology and also we think based on the conversation with the company that the semiconductor up cycle has been very long and it's getting a little bit tired. We're seeing competition picking up with the memory chip competitors, and also the companies getting a little bit reluctant in giving us a more constructive and optimistic view in terms of the forward guidance. So I would say a lot of pressure from the fundamental point of view even before the war, but interestingly, interestingly, actually this week I'm in Seoul. I'm visiting some of our investors and a couple of issuers. It's very cold here, but I would say the investor sentiment is actually very positive, and that was really to my surprise. I think a few things they pointed out is the first, in the Korean won funding market, the funding condition is still very good, even though Korean won rates has gone up quite a bit. It's probably one of the worst performing Asian rates over the past 1 month. But they think the regulator is providing a lot of liquidity backstop. The Ministry of Finance is purchasing Korean government bonds. So they think the rates are not going to stay there for elevated levels for extended period of time. And a lot of them are starting some receiving position in Korean rates. They're also not pessimistic on the currency. A few lifers and few asset managers are saying 1,500 is really quite elevated level for Korean won, and they're actually increasing their USD hedging ratio because they think there's a potential for the Korean won to appreciate against the dollar. And lastly, I think the domestic investors are very comfortable with the financial regulator. They always very proactive, providing support for the financial institutions. So what I'm hearing from the investor here is they are still bottom fishing, are still buying the Korean corporate papers. I think that's why if we look at the performance over the past 1 month, it hasn't been like really catastrophic relatively to the fundamentals. Some of them are saying the banks and financial papers are cheap and could still tighten a little bit. I think we're kind of like holding an opposite view on that. If we look across APAC, it's not really that attractive, but they think it's attractive. They also thinking right now a lot of the new shoes are offered at very attractive premium, and they are very active in the new shoe market. That probably explains why the Shinhan Bank one didn't really offer it as a significant concession to the market. And they're also adding a bit of duration in the Korean corporate paper. So I would say a mixed bag, very supportive technicals, and sometimes it's very hard to go against the technicals, but fundamental wise, we do have concerns. Yeah, back to you, Pramod.
Thanks for walking us through that, Zerlina, with a lot of live input from what's happening in Seoul. Appreciate that. I'm just going to take a quick look at some of the questions that have come in and address those. Some of the questions are now moving outside the purview of what we've covered during the course of this discussion, and asking about AI and BDCs. On the BDC side of things, just pleased to let you know that CreditSights is going to be coming out with coverage of the BDC names before too long. So that's something that our clients can definitely look forward to. It's obviously a space that's very topical. We have a couple of questions along airline implications of the crisis. Sadly, that's not a space that we cover, so won't really be able to go into that too much. There is a question though, and this I'm going to pose to both Zerlina as well as to Dheeraj, and is what downside scenario should long-term investors be most mindful of in Asia credit this year? So Zerlina, maybe I can start with you.
Yeah, sure. So for a couple of years, we have been a big advocate for clients to diversify into non-USD related fixed income assets, including Australian dollar, which we are still very constructive on. I think since the war, because the DXY and the dollar index has improved, appreciated a little bit. So some of our clients are having a second thought on diversifying into the Asian local currency space or other currencies. But I think if we look into a medium to long term horizon, we think structurally the dollar do still have the downside risk of further depreciation. I think for a portfolio management point of view, it is still worthwhile to have some asset allocated to the non-USD assets, including the Australian dollar market, which is improving the depth and breadth and has a wide range of issuers coming to the market with sizes. So I think the risk of fully allocated to dollar-heavy fixed income portfolio could be missing out of that additional alpha opportunity coming from the Asian local currency space, especially given the entry point is a lot better now. So I would say this is the old theme of continued diversification, but stay invested.
Thanks, Zerlina. Dheeraj just reminded me about one point in frontier markets. I didn't mention when we were walking through that we've done a lot of work around Mongolia. We put out a note yesterday on Column Bank, so that's the main bank that we cover over there. And actually, Mongolia seems to be in a better position than we'd imagined. They're getting low-cost petrol and oil from the Russians. They have copper and coal exports which are in demand. The political situation seems to have sorted itself out towards the end of last year. So we moved gold into an outperform yesterday. Not massive upsides, maybe 50 basis points of upside. It's 350 over the sovereign. It maybe 300 over the sovereign is fair. But that's perhaps a very good example of the kind of idiosyncratic risk that we are or idiosyncratic opportunity, rather, I should say, in the current context in Asia, given whatever is going on. So with that, we'll wind up our webinar. We're close to the hour, which is what we'd promised. Hopefully, for our viewers, you've got some good takeaways and actionable ideas that you're able to put into work. For the key actionable ideas, again, I'd point you towards the Asia Credit Best Ideas piece. That's something that we put out at the beginning of every month. So we do flip our portfolios from time to time or put on new ideas. So do watch out for that piece. And I'd just like to thank Dheeraj very much for taking the time to join us today, as well as my colleague. So thank you, everyone. Stay safe. And we look forward to seeing you the next time we have a webinar. Thank you.